Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with this Thursday expert, Mr. Jonathan Twomley. How you doing, sir?
I'm doing well, Michael. How are you?
I'm doing wonderful. I'm curious about something. Um, you know, Interest rates are a big deal in the residential game, which I look at every day. We have seen a movement in the 30-year mortgage rate like only one other time in the last 50 years, right? There was one kind of 4 or 5 month window where Paul Volcker was taking rates up really high, where there's a similar 200 to 250 basis point move. So we do have one historical example, but I'm curious in the commercial space, rates are up there too, or there as well, I would assume. Um, Wells Fargo this morning talked about mortgage demand at the bank down 33%, which is significant. It's funny, on Monday, I'm like, I wonder which bank's going to talk about mortgage demand. And again, this is Wells Fargo's mortgage drop was when rates were in the fours. They're now in the fives. So I can't imagine what Q2 is going to be like. But do you look at, you have to look at interest rates. Are you up to date with all the Fed going 50 basis points here and there? How much do you look at rates?
I am aware of what the Fed does, right? Because it does affect the final interest rate that you're charged, because the interest rate is composed of, where the banks can borrow money at plus the spread that they attach on top, right?
Yeah.
So if interest rates go up, they will adjust their spread. Sometimes they'll take a little bit of a haircut if they want to remain competitive, right? And so that can buffer the interest rate a little bit. But if interest rates go up by a point, into, like, let's say the Fed raises rates by a full point, the way it's being predicted, that for the next two meetings it will go up 50 basis points each time, banks are not going to take a full point haircut on that spread, right?
No.
So it will push interest rates up. And this is obviously, this will affect your profit in multifamily for sure. And it affects your ability to do deals, but it has not as of yet affected the demand for property.
Interesting. Okay.
The reason for that is, there are a couple of reasons. One is that there is a lot of money out there looking for a home, right? And this is, different from homeowners who have their savings and they're limited by that. This is all, there's large investment funds out there that just have money that needs to be placed.
Yeah.
They don't make money if they don't invest the money. They don't want to return the money to their investors. And yields are low everywhere. Although I'll talk about in a minute how that could change, but and multifamily still remains one of the better places to invest your money, right? You're looking for yield. So the demand remains high. And the other component is that with the rent increases that we've been having over the last couple of years, the people are willing to overpay because they believe that the rent growth is going to grow them into a more profitable position, right? And so far that has worked, right? So we haven't seen an end to those rent increases yet, right? But nobody knows how long it's going to go on.
Right.
Some people are predicting it's going to go on for a long time. Other people are more cautious about it. If you look at CoStar reports, at least like what I've been looking at in CoStar reports, I've been on deals I'm looking at, they're projecting fairly strong rent growth like this year, but then it starts tailing off. Like they're not willing to project that kind of out indefinitely, right? So they kind of bring it back down to the historical mean, after 2 or 3 years generally. But you still have this dynamic where people are paying up for property based on rent increases that they anticipate. Right. Now, what you will have happen at some point, though, is if rates go up enough, right? We've talked about this on the podcast before. The amount of money that you can get, like when you're buying a home, the amount of money you get is dependent on your income.
Correct.
Like the bank is going to apply some metric. They're going to say, okay, if you make $100,000 a year, you can afford, your housing costs can be $33,000 a year, and whatever that translates into is with the interest rate and everything. In commercial lending, the determination is basically how by how much does the net operating income,
Mhm.
that's your basically your operating profit, by how far does that exceed your debt service, right? So if your debt service, the amount of money that you have to pay in principal and interest back to the bank every year is $100,000, your property must produce $125,000 a year
Or more.
in order for you to get the loan, right? So at
Okay.
least, right? And so, and if interest rates go up and it causes that 100,000 to become 105,000,
Right.
then that 125,000 needs to go up by 5% too,
Mhm.
right? And if it's not going, if it hasn't gone up by 5%, and they look at this based on the current rents that are in place, right? So you can't say, oh, well, we think rents are going to go up 5% next year. The
Mhm.
bank is going to say that may not happen, right?
Right.
What are they now, right? If your rents are not showing like that immediate 5% increase
Right.
right now, then the bank is going to say, we're still only giving you $100,000.
Got
But
it.
that, like a debt service, like
Yep.
equivalent of $100,000. And that may mean that they're actually only going to give you 71% LTV rather than 75%. And maybe you're counting on 75%, right?
Okay.
So now you've got to pony up more equity. It means your returns are lower, right? You've
Right.
got less leverage. Or
Yeah.
at some point,
You either get, so really there's only two options at that point. You either bring in more equity, as you've just said, or you get the seller to take a haircut.
right.
Right. Because
And sometimes you can, sometimes that happens. Because if you make an argument to the seller that, hey, this is going to affect everybody,
Yep.
The seller may, they've already kind of psychologically,
They're out. Yeah.
like made the sale in their minds. And if they're saying, okay, well, I'm going to take $500,000 less, but I'm still making, I'm making 4.5 million in profit rather than 5 million. Okay, like I can live with it, right?
Right.
So that may happen, but in the longer run, what you're going to see is there'll be pressure. This is going to cause downward pressure on pricing.
Yeah.
The bank will as much.
The big question I have for you, and again, it doesn't really play in residential. Is there a rate where the 10-year really becomes a competition for multifamily investors, right? Because right now, there for the longest time there was no better place to invest, right? The Nina, right?
Yeah.
Trade. And is there? I mean, if the 10-year was at 5%, does that pull away from?
Absolutely.
Okay.
I would say once you see the 10-year getting up to even 3%.
Oh,
right,
interesting. Okay.
I think you're going to have some of the most conservative investors out there will start going into treasuries, right? Some of your insurance company money is going to get diverted into treasuries if they get to 3%.
Okay.
Because insurance companies are happy with a 3% yield on a Class A, apartment building, right?
Right. Yeah. Yeah.
Why would you, if you're happy with it, if you're willing to put money into an apartment building, even if it's Class A, right, the highest value property, but it's an operating business, right? And it is not a guaranteed 3%.
Correct.
If you're weighing like, well, am I going to buy an apartment building at 3% or put it into a treasury and get a guaranteed payment at 3%? Some of those investors are going to go for the guaranteed payment. Now, obviously, they would be missing out on the back end.
Sure.
But if what they are trying to do is
they're playing
create a stream of payments for themselves, right? As an insurance company needs to. Some of that money is going to go into treasuries. And if you start getting up to 5%, then you start becoming pretty competitive. And of course, it's going to push up up the yields on apartment buildings too, when you start seeing treasuries go up that much, because it's just going to suck away some of the money, right? So
so the 10-year, I think this morning was at 2.7, I think. So, I mean, there's a chance. Again, the Treasury is interesting, right? The Fed has only done a 1/4 point move. We're still at 0.375 Fed funds rate. They're talking about a full 100 basis points in the next 2 meetings, maybe 150 in the next 3. I guess what I'm saying is the 10-year could see 3% this year. I mean, it could happen.
I think if it does, you'll see some money flowing into treasuries.
Okay.
It might not be enough to really affect
No,
But
it's still your pile of money is still this big. It's just at the
yeah,
edges, right?
yeah, but I think it'll start to have an effect. And I think if the Treasury, like you said, if it hits 5,
Yeah,
then
that's a game changer.
you're going to really see,
Okay.
a lot of people looking at like, hey, because they're also going to be thinking not just like, hey, I can get 5 guaranteed. They're also going to be thinking, okay, well, what happens to the real estate market if the
Yeah.
Treasury is 5, right?
Correct. Yeah.
So that's going to change some thinking at the margins for sure.
Okay. All right. So that's I wanted to know that. And then the last thing to talk about in residential, I actually, everybody talks about a housing market, and I actually talk about a lending market. Lenders drive the bus, if you will, in residential. They can get tighter or looser. I don't know if you know this, but in residential, FHFA April 1st started adding layers or fees for investment loans. They are clearly anti-investor today and pro-homeowner. Have you seen in banks get more or less conservative, or has there always been, kind of 1.25 debt service? Does it ever change? I mean, do lenders get skittish and aggressive?
Oh yeah. I mean, after the great financial crisis, they got a lot more conservative.
Okay.
So they sort of reformed things quite a bit. For instance, they stopped going over 75% loan to value, or some loans you can still get 80%, but they capped it at 75, and they also then forbid you from getting second mortgages on properties.
Okay.
Right? Cap leverage, and they instituted this DSCR requirements and things like that. So
Okay.
they did, but they haven't become more conservative since then. I think that those underwriting standards have kind of stood them in good stead.
Okay.
But they also have, as prices rose, though, those underwriting standards started making it more difficult. So they started doing things like interest only, right, and which is a way of loosening without loosening the standards, right? So they still kept those DSCR requirements and stuff, but they started giving people, first you only used to get IO for like for bridge debt, right? And then the bridge lender started eating the bank's lunch, right? So the bank started giving, we'll give a year of IO if you're doing a rehab and you need a little extra cash, right? Then it became 2 years and 3 years. Then, I've heard rumors of like non-amortizing loans from banks, 10 years. Wow. I mean, I haven't seen them myself, but I've heard people talk about them. I don't know where they're getting them from, but there's just, so they do kind of, that will go away. I think if things, they're going to want to get their money back sooner. But yeah.
Very, very cool. Well, folks, Jonathan talks about this stuff all the time. You can follow him in lots of places. Where do you want him to go?
Well, listen, for this conversation, go to my free Facebook group, Multifamily Investment Community. That's just a great way to kind of my world. And if you want to, learn how to do this yourself, you can go to multifamilylaunchpad.org/join and learn about, how to join my coaching program. And finally, if you would just like to give me your money, not to spend it, I will put it into a deal. You can go to just Google Two Bridges Asset Management, and you can see the investment form and get onto my list.
Very cool, Jonathan. Thank you very much.
Absolutely.